we've had really so many waves of, I guess, valuation adjustment in parts of the NASDAQ. You've had really even the mega caps have become looking cheap in some regards, something like a Meta. Yet Apple has kind of retained this big premium. How would you try to boil a lot of that down to say how much of the macro and policy stuff has already made its way into that complex?
Well, there's a lot to that. So, look, we've had a massive de-rating since the beginning of the year because, Michael, as you well know, we had a massive re-rating last year. So we had multiples that were well above their average bands going into the end of 21, and we took all of that out through June. And then we went into estimates risks, estimates cuts. And I've had 3 quarters in a row where about 70% of the companies that I cover, I'm talking about the December, March, and June quarters, have had negative estimates revisions, and relatively material ones. I haven't seen that level of negative revisions in multiple years. And I hope that the numbers or estimates are down enough to accommodate the softening recessionary conditions that we're obviously going into. We don't know that, but I hope the numbers have been cut enough. So at least a lot of the valuation risk has been taken out. Your prior desk talked about hard money, easy money. That's how I now think about stock picks. So if you tell me we got hard money environment for the foreseeable future, sustainably high inflation rate, and sustainably high interest rates, it's a different list of stocks you want to be looking at than if you've got an easy money outlook.
Yeah, so characterize what hard money stocks look like right here. I mean, kind of the observable earnings support and balance sheet stability, or what? Yeah.
Yeah, you got it, Mike. So it's companies that you can look at and say, well, in free cash flow, or these companies are trading at 12, 13, 14 times GAAP earnings. We're not doing EBITDA. We're not doing adjusted earnings. So I'm talking about in the space that I look at, I'm sure Apple and Microsoft fell into that. But in the space that I look at, it's Google would be one, Meta/Facebook would be another, Booking would be another, eBay could be a name in there. And then if I want to get a little bit creative, I actually think a name like Uber could work into that, because I think you're going to start seeing a real dramatic increase in free cash flow there. But I'd throw all of those into my hard money basket, names that can outperform, but they've got to have free cash flow supports. They can't be long duration assets. They got to have real profits in 22, 23, not 24, 25. Their long duration assets won't work in a hard money environment.
I have to say, in that category that you described there, Meta does really stand out, just in terms of how it really didn't get back much of the total losses from the highs. It really does screen out as looking very cheap based on current earnings and all the rest of it. Just what is the nature and the level of skepticism about the current earnings power of this company that's leaving the stock where it is?
That skepticism, Mike, is dramatic. This is the new eBay. This is the new Yahoo. It's perceived, i.e., to be a melting ice cube, a deteriorating asset because of TikTok, because of these privacy changes that Apple implemented that really kind of gutted a lot of the advertising marketing plans that were out there, or the ability to really track and measure campaigns. And then there's regulatory risk being thrown at Facebook, and then there's just this belief that it's matured out. I don't think those 4 headwinds are accurate, or at least I think they're hedges against the headwinds, if you will, if that's not too complicated. So I like Facebook here. I think there's a path for revenue growth acceleration. They haven't had their breakout quarter. Amazon, I think, had that last quarter. Facebook hasn't. Meta hasn't. But I think it has the potential to do that as they start turning on Reels monetization, and as they do other things to improve the platform. And this is a really nice business model. Even under duress, it's 30% operating margin. Even under duress, they're generating $25-30 billion in free cash flow a year, which will give them plenty of strategic options. And they're returning that cash to us as shareholders. So I just think there's a lot to like about Facebook when the market certainly doesn't.